we use this term as delusionally optimistic. Now, it doesn't mean that everyone who's delusionally optimistic makes a great CEO, but someone who is pessimistic or too realistic is going to get pushed around by the world. You want someone who wants to push the world around, be a little unreasonable, and help people change the way they behave by using the product or the service that the company generates.
John Frankel is a legendary investor
who went from Goldman Sachs
to now backing unicorns.
I think the things that we look for investors are the same things that most VCs would say. But the differential things are...
Welcome back to Decoded. My name's Alfie Whattam, and this is the show where I speak to experts about what it takes to build great teams and companies. Make sure that you click the follow or subscribe button for more great content like this, and I hope you enjoyed the episode. So, John, you've invested in Omaze and Soccer and Cornerstone on Demand and so many other massively successful companies. So what do you look for when you're deciding to invest in a startup?
Well, that's almost a non sequitur. I mean, as an investor, you hope to get lucky, and I think we've got lucky a few times for sure. And those are actually pretty amazing companies, and we've been, lucky in that regard. But I think the things that we look for investors are the same things that most VCs would say. But the differential things are we look for an investment in a company that we think is a business. And by business, we mean has or can have a business model, can actually generate revenue in an easy to understand way. And where we think the arbitrage that business have, because all businesses are arbitrage, is sustainable because they can develop barriers to entry. Now, obviously, we look for a very strong team. We look for a CEO who... we use this term as delusionally optimistic. Now, it doesn't mean that everyone who's delusionally optimistic makes a great CEO, but, someone who is pessimistic or too realistic is going to get pushed around by the world. You want someone who wants to push the world around, be a little unreasonable, and help people change the way they behave by using the product or the service that the company generates. We like the CEO to have a strong sales capability, not just be a scientist, as it were. And it is too easy sometimes for startups to become science experiments where they raise capital and they pull away at the idea and the theme and what they're trying to solve, but never actually build a business from that.
Okay, so a founder who can sell, who can market, and who can create a reality distortion field to get other people, whether that's customers, whether that's investors, whether that's the media, bought into that vision, but also somebody commercially minded, somebody who can take that idea, that technology, that product, and actually build a scalable business around it. You mentioned something at the start there when you said that you got lucky a couple of times. Okay, how do you increase your chances of luck? Because you've got lucky too many times for this to be an accident.
Well, thank you for saying that. Flattery will get you everywhere. So if you think about the distribution curve for startups in terms of returns, it doesn't follow a normal distribution curve or normal with outliers, which is what the public markets are meant to be. Private markets are the ultimate buy and hold. And because of that, you end up with something close to a power curve distribution. A way to visualize that is if you have 100 pre-seed funded companies, 30 raise a Series A, 10 raise a Series B, 1 goes public. And so what are the things that you as a VC can do to tilt that curve a little bit? More raise an A, more raise a B, hopefully more go public or an exit. By the way, I think out of that first statistic, the close number I have is about 16% exit from M&A. So you have, 80% of an average portfolio failing. And so if there are things you can do the differential, you can skew higher. And the return distribution amongst VCs is higher than, say, hedge funds, because you can't hedge.
Yeah.
And because it is the ultimate buy and hold. So, so the sort of things that we've done, and we've tried a lot of things over the last 17 years. The firm was founded in 2008. The things that we've done, which they sound really simple. We tend to lead rounds and sit on boards. We tend to talk to our founders and our CEOs and our teams, and we just try and, by staying in conversation with them, understand the issues they're dealing with, and then play this giant game of concentration of matching up resources and other dynamics we can bring to the table. And where we see issues that we think are portfolio wide, we then really try to rally resources across the portfolio to help the companies. But statistically, because we have now 17 years of data, statistically, about 2/3 of our companies raise a Series A. The average is about 30%. About half our companies raise a Series B. The average is about 10%. So about 5 times survivorship Series B. And we've had a little over 11% of our portfolio companies get to 100 million revenue run rate, become a centaur, as it were. And the centaur is a great pathway to becoming a unicorn. If you get a 10 times multiple, it's immediate. But, it depends on the business and the growth rate and everything else. Net, we have higher survivorship statistics in our portfolio. And it's tough to know, the particular thing you do. We've had companies that have executed excellently along their life and then trip over their shoelaces and exit badly. And then we've had companies that have been okay and then get lucky. So there's a whole series of things involved in this. But I would say a couple of things that are a little different than other VCs. One is we really try to educate our founders around understanding product line P&Ls and contribution margin P&Ls. I think we're the only VC firm that actually built an accounting firm called Graphite Financial. We actually spun it out and sold it a few years back, as managing 40 accountants was becoming something that was not sort of core and central to where I wanted to spend my time and energy. But we really felt there was a missing piece in the ecosystem for an accounting firm that didn't just do GAAP accounting, but understood the cash impacts of this. Very few founders are CPAs. Founder being a CPA might be a negative signal. Very few founders are CPAs, and very few VCs are. And so you end up with people not understanding the metrics. I think probably 10% of companies fail because of poor accounting. And that's something no one really talks about. The other thing is, founders trip over their shoelaces from time to time. We've had a number of times where founders called up and said, we can't make payroll on Friday. Now, if understanding VC math, right, if you remember this sort of depreciation curve, about 85% of your returns comes from 10% of your portfolio, if it were equal weighted. And so, VCs are busy. They have the attention span of a 4-year-old. Founder calls them up and says, I'm having trouble. The easiest answer is, well, that's a pity. We tend to listen, and we've often stepped up. And for some of our companies that have gone on to do very well, they would have gone bankrupt earlier. And so, to be clear, sometimes we step up and we put in, time and capital and the like, and it doesn't work out. But we have enough time under our belt that we actually think that on a risk-adjusted basis, it's a high return strategy for venture firms.
This is a quick message to tell you about my company, Alpha AI. We built Lisa, the world's first AI-powered recruiter who screens candidates for you on autopilot. You can make your recruitment process 10 times faster, 90% lower cost, and significantly improve the candidate experience, all with our AI agent for hiring. Learn more at welovealpha.com or click the link below in the description. And now, back to the episode. Okay, so for those founders listening to this, I guess like myself, who are VC backed, they want to become that power law, they want to be that unicorn. What's a mistake that they should avoid, aside from the accounting? That's obviously very important, but you've mentioned that one. So what's something else that you consistently see founders do, which is a detriment to their business and it stops them from, becoming those breakouts?
Well, I would tell you, I would watch season 1, season 2, and definitely season 3 and season 4 of Silicon Valley.
Yeah, great show.
There are too many embedded lessons in there.
Yeah.
You have to think about funding rounds as staging posts, not as the end game of themselves. They're not the war, they're the battle. And so you have to think about sequencing of raising funding. I've seen companies raise money at valuations that were objectively high and then create enormous problems for them subsequently. Founders tend to raise, the more money they raise, the more money they spend. It's rare to find a founder who raises a lot of money and spends it as if they didn't. So those are a couple of dynamics. So there's always a trade-off. Runway is your best friend. The longer you have to execute against, the longer you have a period to get lucky as a founder. But you sometimes have to be realistic and know when you need to pivot or cut bait.
The longer the runway you have, the more shots you've got to take at the goal, and then the more likely you are to score, and then you can double down on what's working. But then there is the opposite argument as well, that like the classic VC mindset of like let's just go after this market, try and take it, put in as much capital as possible, just burn it as quickly as possible. And it seems like there's a bit of a what's the answer, this one or this one? It really depends on the market, depends on the time. But
I mean, there are periods where capital is a weapon.
Sure.
But I have seen too many companies raise money at high valuations, spend it, and then the capital markets change.
Yeah.
And so, I think capital efficiency is really important, not just for early stage VCs like ourselves, but also for founders. The more capital you raise, the more dilution you're taking on, and the like. And the markets change. Capital markets can be easy to raise today and terrible to raise tomorrow. And ultimately, you're trying to build a business, and the business is about returns, and it's about returns to shareholders. And you, as a founder or part of a founding team, you get diluted by every dollar that you raise.
I liked your point earlier. Look, I do some angel investing, and you're absolutely right that whatever founders raise, they tend to spend pretty closely to their financial target, or often a lot beforehand. The runway and the burn.
I described them as like 18-year-olds with a credit card.
Yeah.
Yeah. Yeah. And by the way, I think what all of this approach or philosophy has really been pretty much the same for the last 25 years. But there is something that's changed in the last year or so. So, we have for well over a decade invested in companies who embedded AI in their product. We used to have an accelerator with NYU back in 2015 and 16, I believe, around AI. And we use the term applied AI, the ability of applying AI into business. With large language models and the tools based on them that have opened up, we now see there's an efficiency to how businesses are run. We use the term AI point solutions within businesses, or apes. And we think that you can now grow companies faster with less people. You can get more done with the people you have. But we think for a company transitioning from the old model to an apes-based model, they can in effect save 10 to 40% of the costs they have for the amount of business they do, or grow faster, etc. And there's a number of dynamics around this. Firstly, I don't know any company that says if I have 10 engineers, I couldn't do more with 30 engineers. So in the same way, if you make each engineer 3 times more productive, I don't think they turn around and say, well, we'll fire 70% of our engineers. They'll say we'll do more work.
Yes.
This ties into the whole Jevons paradox, and I don't think there's a limit in that regard. But there is an advantage of smaller teams. Smaller teams are more nimble, and there's less bureaucracy and politics in the organization. The smaller it is. So I think smaller companies have an advantage to move faster. Secondly, and I've seen pretty much every technology transition from mainframe to client server all the way through. This tech stack puts power in the hands of the person who does the work. In the same way that when spreadsheets first came out, client server, back in the mid-90s, early 90s, it really did the same. And so it's incumbent upon people, the common term says with agency, reinvent their jobs around the new tool set. And so it's incumbent upon management teams to create a culture that fosters this kind of dynamic. That if you have someone who's working a job that would be a 50-hour work week, and they can compress that into 5 or 10 hours, that is recognized and they're rewarded for that, as opposed to the person saying, well, now I'll take on 3 jobs and I won't tell anyone. Who gets the benefit of all of this automation? It's incumbent on companies to change how they hire, to hire people who respond to that kind of challenge, as opposed to people who want to clock in at 9 and clock out at 5. And it's a technology wave unlike prior ones that I've seen, because the tool set you have today, and today happens to be a Monday, will probably be different than the tool set you have on Friday.
Yeah.
Whereas if you go back, spreadsheets took years, and if you understood them, great. And if you didn't, you could understand them a year or 2 later. The technology was the same with the internet. But here, a technology is moving so fast that it's very difficult mind-numbing to keep up with the advances that are out there. And so you really need to have an organizational approach, an organizational culture where everybody is using whatever tool sets they can get their hands on to improve their job and be recognized for that.
I mean, it is certainly the most exciting time to be alive, in my opinion, ever. And I loved your example earlier around, software engineering agents allowing a developer to become a 10xer. And that doesn't mean a business would replace them. It means a business would make them, more productive and effectively be able to hire more of them. But by using agents, replicate the abilities. And I've seen that in my world. I have a AI VC-backed recruiting startup with agents for staffing and hiring and that sort of thing. And some companies use it to replace their recruiters, and that's fine. But the best ones, they use it to turn every recruiter into a rock star and automate all the admin so they can spend more time on the important things that matter and building relationships and that sort of thing. So it really echoes the point that you mentioned there.
Whenever we've had technology wave, it's easy to see the jobs destroyed. It's difficult to see the jobs created.
Yes.
So in England, it started off with the Luddites when looms were automated with steam engines, I think, if I'm correct. Someone will correct me if I'm wrong. And they marched to London demanding this automation be stopped because their jobs were being destroyed. And the Luddite argument is very seductive. Maybe this time it's right, but I don't think it is. I think we're on the cusp of enormous job creation and enormous job destruction. And the combination should leave us with much more interesting things to spend our time on. Technology, it just allows humans to move further up the interest curve over time.
Yeah. So going back before VC, you had a 21-year career with Goldman Sachs, and then you founded FFVC in 2008. Now,
Correct.
What prompted you to make that leap into venture? How did your Wall Street experience shape your perspective on startup investing? They're both finance, but it's a very different type of doing it. So,
as you mentioned, I joined Goldman in '86, which is a while back. Prior to that, I was at Arthur Andersen. I qualified as a chartered accountant. And that was the sort of MBA path in the UK back in the day. So I look around and I go, yeah, accounts is not for me. I've got the qualification, I can read a balance sheet and income statement and but it's not for me. And I looked around, I applied to a number of companies. I got into, I applied, I think, to 6. I got into 4. The one that was least known in the UK and was offering the least money was Goldman Sachs. And, I had to choose between the 4. I spoke to one of my friends at Arthur Andersen. He said, no, that's the one you want. So I joined Goldman in controllers. I moved through operations, set up the offshore administration business, London global custody business, re-engineered prime brokerage. And then I moved into equity research sales. So the last 11 years, I was on the sales and trading floor, covering hedge funds for US shares. And 99 was a crazy year. My personal trading account was up a lot. And I started to accumulate capital. And I just looked around and said, everything is high beta. Where's our alpha that doesn't have a mark to market? And I started angel investing. And then by the time I left Goldman in 08, I'd actually been very successful at earned more on a realized basis than I had working at Goldman for 25 years. And said, maybe I should take this professional. And so, started the firm. November 08 was a great time to raise capital.
Terrible time. Can I let me ask you about that? You raised your first fund in 2008, which was, you said, the most illiquid market you could possibly imagine. So how the hell did you persuade LPs to fund you during that downturn? What lessons did you learn from that hell, I imagine?
It's always a bad time to raise capital.
Yeah, but that was a really bad time, John.
Well, I mean, to be clear, we wanted to raise 25 million. We raised 8 and change. And it was friends and family. It's people who knew me and had seen the success up close. And, just as much as everyone was running to money markets and then trying to work out what was asset-backed commercial paper, which money markets were invested in, and what's the risk. Everyone was worried about counterparty risk. There was some people who knew me who had enough liquidity and understood the simple thesis that if you have some wealth, it doesn't all have to be, at the most liquid part of the curve. The more liquid you are, generally, the lower the return opportunities there are. There's usually a trade-off for illiquidity. And trade-off for illiquidity is when you get it right, you can be up 30, 40, 50, 100 times your money. Not 100%, 100 times. And that offsets the ones that don't work out.
Yeah.
And there's a return curve, which is decent. But if you can tilt the curve a little, which was our thesis, you should have better than decent returns.
And you can only lose what you put in when there's no shorting it in VC or angel investing.
Right, but it's uncorrelated. It's a basket of diversified alpha, and it's uncorrelated to the price of gold, the price of oil, the public markets at some level. I mean, it starts off a basket of alpha. Your winners become beta, right? And so how your winners exit materially impacts your returns. Today our largest companies are all talking about where they sit on the rule of 40 and how they can exceed that. And I'm sure you're aware there aren't that many public companies that exceed the rule of 40. And for those who don't know what the rule of 40 is, it's this strange addition of your EBITDA margin with your revenue growth rate. And it's trying to deal with this thing of investing cash, which would reduce your EBITDA margin, versus growing faster.
John, this has been super useful for people that are starting a company, people that are investing, people interested in our world. If they have enjoyed this and they want to learn more, where should they go to? Would it be your LinkedIn, X, the funds website? What's the place they should be directed to?
X is pretty good. My X handle is John_Frankel. LinkedIn is tough. I get like 20 people a day who want to connect on LinkedIn, so that one's tough. And then we have a website, ffvc.com. We also have a newsletter that goes out to about 25,000 people twice a month, and anyone who wants to be on that, just ping me on X and I'll make sure they get added.
Awesome. John, thank you.
Not at all.
Thank you so much for watching. Make sure that you click the follow or subscribe button wherever you're watching, and I'll see you in the next episode.
Introducing Lisa, the world's first AI-powered recruiter. She's an AI agent who works 24/7, screening candidates on autopilot, conducting interviews in 30 different languages, uploading all the best candidates to your applicant tracking system. Hire 10 times faster at 90% lower cost and significantly improve the candidate experience. Visit welovealpha.com to start your free trial now.